Welcome, good evening, good morning, good afternoon, depending on which time zone you are in and where you're joining us here today. So it's my great pleasure to be the chair of this really exciting session on international macro modeling. And before I briefly before I'll give the word to Mick, who's going to be our first presenter, let me just briefly introduce you to the Q&A, how it works. So you can submit your questions in the Q&A chat, and I will keep an eye on this, and I have some great support in the background that helps me managing this as well. Alternatively, so if you don't want to use the chat, later on in particular in the Q&A session that follows each of the discussions, you can also just raise your hand, and then depending on when it's your turn, I will ask you then to speak. So now, without further ado, let me turn the microphone to Mick Devereux in 1 second. So he's going to talk to us about trade wars and currency wars. This is joint work with Stephane Auray and Aurelien Eyquem. I hope I somehow managed to pronounce this somewhat acceptably. And Mick's presentation is going to be followed by a discussion by Jinill.
Okay, so thanks a lot, Martin, and thanks to the organizers for inviting us to present this paper. As Martin said, this paper is co-authored with Stephane Auray and Aurelien Eyquem from Rennes and Lyon. And the paper is an analysis of the strategic interaction of monetary policy and trade policy in a very standard two-country New Keynesian model. So in a nutshell, that's what we do in this paper. Now, let me kind of motivate the objective in a little way first. There's a very large literature that goes back for a long time on non-cooperative international monetary policy, going back to even before I was in grad school, which was a long time ago. And recently this literature has kind of heated up, and the catchword of this is the idea that there are currency wars between large countries in an international monetary system because of negative spillovers of monetary policy. On the other hand, until quite recently, we didn't really think too much about the impact of trade policy in the macroeconomy, because really trade policy was determined by a rules-based formulation with WTO, etc. But recently we've had this growth in protectionism, and we've had, discussion of trade wars and retaliation for tariffs and so forth. Now, why do trade and macro policy interact? I mean, why is this interesting? Well, from a theoretical point of view, we know that monetary policy is effective due to nominal rigidities. And in an international setting, monetary policy has spillovers because it affects the terms of trade. That's a key element, a key channel in New Keynesian models. And optimal monetary policy depends on the source of price stickiness. Now, tariff policy also affects the terms of trade. And in a model with nominal rigidities, it affects the output gap. And in addition, optimal tariffs in a model with nominal rigidities depend upon which prices are sticky and how the exchange rate responds. So in a theoretical sense, these two types of policies are going to interact substantially. So they form, in essence, a part of a general strategic environment, and that's what we're going to focus on. Now, in practice, of course, there is a large interaction between trade and monetary policy. Protectionism typically is focused on macro targets like employment, the trade balance, but also protectionism tends to respond to movements in exchange rates. We have all this discussion about currency manipulation and so forth. So what this paper does is the approach is very standard. We have a two-country New Keynesian model. We have sticky prices. Monetary policy has spillovers or currency wars because of standard kind of terms of trade externalities. Trade policy sets tariffs, and we're going to look at trade wars. They also involve a terms of trade externality and affect the output gap. So I'm going to give you a preview of the results. The bottom line, and I'll emphasize this again if I have time, is that these things really do, in a theoretical framework, interact a lot, and it depends a lot. The impact of the outcome for trade policy depends a lot on the type of monetary policy that is being followed. So we find that currency wars alone have very small welfare costs, and this is very standard and known in the literature. But currency wars and trade wars have much bigger welfare costs, and they do interact with one another in key ways. So I want to basically, in the very short time I have, the paper is much longer and there's other kind of results in it, explicate three results. First of all, eliminating currency wars, the idea that, we want to eliminate this possibility of spillovers and currency wars among the major monetary authorities, that can lead actually to much greater protection, according to our model. The second result is that the exchange rate system matters a lot. So, in contrast to kind of some conventional wisdom that a fixed exchange rate is type of currency manipulation that gives rise to more protection, we find that in an equilibrium we focus on, an exchange rate peg leads to much lower protection. So by fixing exchange rates, you significantly reduce the incentives for protection, for manipulation of terms of trade and protection. And the final results that I'll hopefully get to today is that the currency of pricing matters a lot. The assumptions you make about, which prices are sticky and so forth. For instance, under dominant currency pricing, which is the type of trade pricing that most people agree on now, that determines the world trading system, trade and currency wars lead to a major advantage for the dominant currency issuer. So in the trade interaction, dominant currency pricing leads to a gain for the reserve currency issuer. Okay, the key takeaway, which I'll get to, is that the currency wars independent monetary policy have little effects. Trade wars are more costly, but crucially, the two things interact in a key way. So the literature is very big. I'm not going to have time to cover that in 15 minutes. The basic setup of the model is very standard. There is, two countries with standard preferences over a consumption aggregate and disutility of employment. In this version of the model, we don't have any financial market trading. We've extended the model to allow for that, and the results are not very much changed, but I don't have time to do that. So the idea is that there is a tariff rate which is just set on imported consumer goods and imported intermediate inputs, and the tariff rate is rebated lump sum to domestic households in each country. So that's very standard. Firms produce using labor and intermediate inputs, which can be imported or purchased from domestic firms, and we have prices are set subject to Rodenberg adjustment costs. So economic policy is determined. The model is solved exactly, and economic policy is determined by the choice of inflation rates and tariff rates. So there's two strategic strategies that each country use: inflation rates and tariff rates. And we also assume policy is made without commitment. So there's discretionary policy. The policymaker takes the future policy as given. The model itself has very few free parameters. We have a trade elasticity of 3, which is slightly on the high side, but still in the range of realism. We have, a markup of 20%. In the baseline model, countries are equally sized. We have standard assumptions about Rodenberg pricing, And we first assume that there's producer currency pricing, which is kind of like the plain vanilla new Keynesian model, although we'll depart from that at the end. So here are the preliminary results. So we saw, because the model doesn't have any analytical solutions, and we want to look at exact welfare optimum tariffs and inflation rates, we solve everything numerically. So what I'm going to show is a series of results just based on the calibrated numerical model. So these are results for the inflation rates, welfare, and the terms of trade in the currency wars alone. So that's just holding, assuming free trade or assuming zero tariffs in each country. So we have a standard result that cooperative monetary policy actually may make everyone worse off. This is well known from Rogoff's 1985 paper, because monetary policy in this model balances a terms of trade externality against the desire to eliminate a monopoly distortion. If you cooperate on monetary policy, you eliminate the terms of trade externality, and you can end up with higher inflation in both countries, which makes everyone worse off. So if we then add trade wars to currency wars, that is, expand the strategy space so that both tariffs and inflation are determined, we have a Nash equilibrium tariff rates of 49% under our calibration. So there's pretty high tariff rates. But what we find is that inflation also rises. So when we have a trade war, because tariffs now are focused on the terms of trade externality, domestic monetary authorities will focus more on the domestic distortion. And so we find that inflation increases significantly in the environment where both the trade war and currency war are determined simultaneously. Now, what happens if we eliminate the currency war? That is, if we say, okay, countries should internalize this monetary policy spillover and eliminate the currency war and just have cooperation in monetary policy, but still have a trade war, that is non-cooperation in trade policy, then we find that this makes things both worse. That is, both on inflation and tariffs. So internalizing the monetary policy spillover leads to more protection in the strategic interaction between countries. So that's the key first result, that, as I said, of the three results, that eliminating currency wars will exacerbate protectionism. The second set of results is with respect to the exchange rate policy. Does an exchange rate peg exacerbate the trade war? We might think so because of the debate on currency manipulation. And so we changed the model to assume that the foreign country pegs the nominal exchange rate, whereas the home country chooses inflation. So the foreign country gives up any monetary policy, independent monetary policy, but both countries now can choose tariffs independently. So there's strategic interaction on trade policy, but not on monetary policy. The key difference now is that with a fixed exchange rate, the terms of trade can only be manipulated by changing domestic inflation. You can't directly change the terms of trade by changing the nominal exchange rate. How does this impact on the outcome? Well, first of all, if we have an exchange rate peg without any trade war, then things are worse off. So essentially, an exchange rate peg without the endogenous trade policy leads to higher equilibrium inflation rates, because it's like cooperation in some sense in monetary policy. Countries don't try to manipulate the terms of trade anymore. They try to offset the domestic distortion. We end up with higher inflation in both countries and lower welfare. However, an exchange rate peg under both a currency war and a trade war has really dramatically different effects. A pegged exchange rate delivers much lower protection. And the key intuition is that it's much harder to manipulate the terms of trade when the exchange rate is fixed. Because in order to manipulate your own terms of trade, you have to raise your domestic inflation rate. But raising domestic inflation rate has its own costs. And as a result, in the Nash equilibrium, where both trade and monetary policy, trade policy and monetary policy are determined, the tariff rates fall from 49% to about 14% in both countries. So the interesting thing is that we still have completely symmetric equilibrium, even though one country is just pegging its exchange rate. But the bottom line is that in a symmetric outcome, the exchange rate peg leads to much lower protection. Now, there is a caveat to that. It turns out that there are multiple equilibria in this conditioned on initial terms of trade. Because the terms of trade is a state variable, you can have quite different asymmetric outcomes where one country has a high terms of trade and high tariffs. The other country has the low terms of trade and low tariffs, and they will be sustained in equilibrium. However, that is, something that I'm kind of not going to focus on now. The basic bottom line is that for a symmetric and any kind of equilibrium around the symmetric the symmetric outcome of the fixed or the pegged exchange rate, we have much lower protection than in the standard producer currency pricing flexible exchange rate case. These are multiple equilibria. I'm not going to talk about those. What happens if we have dominant currency pricing? Now, this has become very well accepted now in the theoretical literature and the policy literature. Trade prices are set in dollars for many parts of the world. Now, in our model, what this would imply is that export good prices are set in terms of the home currency. Now we have two terms of trade. We have a terms of trade in the home country, which is the price of foreign goods in home currency relative to the price of home goods in home currency. We have the terms of trade in the foreign country, which is the price of foreign goods in foreign currency divided by the price of home goods in home currency multiplied by the exchange rate. You can see the key difference there is that the terms of trade can be manipulated in the foreign market by moving the nominal exchange rate, but they cannot be manipulated in the home market by moving the nominal exchange rate because prices are all set in home currency in home market, including the prices of foreign imported goods. Now, what does this imply for the strategic interaction between trade and monetary policy? I just said that, just to set up the scene here, I've got I think 2 minutes left.
Yeah, we should probably wrap up slowly.
Yeah, I've actually basically said this. The strategic choice now are that both countries choose domestic PPI inflation and terms of trade. The foreign country lets the inflation rate in the home market of its goods be endogenous. Now, what are the results here? Well, a currency war alone, that is monetary policy interaction, gives no advantage to the reserve currency issuer or the dollar currency issuer. So it's still symmetric. Both countries have same inflation rates and they get the same outcome. So having the reserve currency or the invoicing currency gives no advantage in monetary policy interaction. However, when we look at both the currency war and the trade war, we find very large asymmetries. With the trade and currency war, first of all, tariffs are much lower than under the PCP, under the basic plain vanilla pricing. And again, because of this, the intuition again is because you need, at least in the home country, you need to manipulate inflation in order to change your terms of trade. But the second key result is that we have very large asymmetries in protection. In a dominant currency pricing, we have actually negative tariffs for the non-DCP country. That is the non currency of invoicing currency, and a large welfare advantage for the dollar currency pricing country. So we have huge asymmetries in the outcome of the currency war and the trade war when we have this asymmetry in pricing. Now, just to kind of emphasize one thing here, if we had perfectly flexible prices, none of these results would hold at all. There'd be no interaction between trade policy and monetary policy. So everything here is based on the fact that there are nominal rigidities, and the nominal rigidities may have very different effects depending upon which prices are set in which currency. So the conclusions, I'm basically done. A currency war interacts with a trade war in very surprising ways. The exchange rate regime matters a lot. A fixed exchange rate on its own is inferior, but may significantly reduce trade frictions. Now, this paper doesn't have any empirical side, but in another paper we have explored this and have some results suggesting that trade frictions do tend to be much lower in a fixed exchange rate, and particularly, if we have a single currency area like the euro, then trade frictions would be lower. And finally, a dominant currency leads to a much bigger advantage in the trade war, but not in the currency war. Okay, thanks a lot.
All right, thank you, Mick. Well, let's turn it over to Jinill right away.
Yeah.
Okay. All right.
Okay. Yeah. Thanks, Martin. So I'd like to thank the ABFER for giving me a chance to discuss this wonderful paper. I mean, this is my first appearance of the ABFER, but should have been last year, but due to COVID was canceled, as everybody of you know. But we are, I think, in the right transition path to not a better but appropriate steady state. Okay, so this paper, as you heard from Meg, showed us how important it is for the coordination of the policies matter, meaning basically strategic interaction of monetary and trade policies. And more importantly, as Mick emphasized a couple of times by using the rub of results, is strategic interaction is more complicated than we think. And then by reading this paper very carefully, I think the strategic interaction of monetary and trade policy is in a better stage or at a higher stage than the analysis of the interaction between at least monetary and macro prudential policies, right? Which has been at the center of the literature, which I tried to contribute, but this strategy is very hard to obtain. So as Martin smiled, many at the central banks agree on that. And then Martin showed us how to do it, at least for the case of monetary and trade policies. And this coordination strategy interaction matters a lot, as we heard from this paper published, I think, yesterday or the day before yesterday by Aurelien and Gopinath. And basically, it matters a lot of how this multilateral or international global cooperation in this our fight against this COVID pandemic. And I'm sure that the coordination of these health policies may have strategic interaction with other policies we are thinking of. But of course, the cooperation of the health policy is the first order at the moment. And I believe the Gita should know that very well because her advisor was the Ken Roloff at Princeton, right? So for the later. But for this paper, I think maybe they had this presentation in mind, which happened last year, a year ago at IMFC, the Asian event where Martin presented as well. And this last year was the 5th, this year was 6th. Last year was a shorter conference of half day and then hosted by the Korea University. And then Mick presented this same paper. Of course, it was more preliminary than the current version. And if I remember correctly, Mick changed the presentation of the paper at a very late stage. And that's possible because there was no discussant at last year. Because of COVID, we couldn't find enough time to recruit discussants. So maybe that's why it was possible. So I'm thinking of like the second best logic. When there is one friction, like having no discussant, Mick used it and changed the title, and then that's might be an example we can use. Okay, so on the contents. So this is from last year. Utility function was much simpler, like low consumption and other features. And I'll get back to the second highlighted parts of the no financial markets. I'll return to that at the end. And then last year, there was no commitment, but Mick didn't have enough time today, but he presented the result about the commitment case for at least for the trade policy today. Okay. So let me first summarize the key takeaways I learned from Mick, and then as a background of my comments and discussions, I'll show you 4 years, 2003, 2008, 2010, and 2020, by having 1 or 2 slides per each year. So the 3 policies he analyzed, trade, monetary, and also fiscal, because that's kind of subsidiary, but in the case of monetary policy, we have to have, usually we have sticky prices, and for sticky prices, firms should have some market power, for which fiscal policy or subsidy policy may matter as well. So Mick effectively analyzed 3 policies rather than 2. And then the 3 key takeaways I had of reading the paper is on the positive economic side. And Mick mentioned it as a strategic interaction of monetary and trade policies. But from a different perspective, he's analyzing both intratemporal relative prices and intertemporal relative prices. By intratemporal, I mean the trade policy, tariff, and fiscal policy, subsidy. And for intertemporal, that's monetary policy, whether he's using inflation as the instrument variables, but we can have interest rate rules instead, which may make the model a little more difficult to analyze. But this intertemporal prices is for monetary policy. And that's another way of looking at it, right? To look at the relative price of both intratemporal and intertemporal. And then the key punchline was on the normative side. And then he had Rogoff results, or sometimes the super Rogoff results of showing how important it is to analyze the interaction among different policies correctly. Okay, so that happens a lot in many countries, I think, especially after the global financial crisis and also COVID, because policies with good intention or well-intended policies sometimes, or more often than not, may result in bad outcomes, and bad outcomes in terms of the social welfare sense in many cases. And that's because this interaction among policies, or maybe you can just have general green effects, that's our jargon, or in the media, it's called unintended consequences, right? That's very important. And then this paper shows us a clear example we can bring to even politicians, I hope. And on the realism side, he analyzed this dominant currency pricing as well as the producer currency pricing. And that showed how, as economists, we should seriously deal with or confront these asymmetry issues. And this dominant currency pricing, I think, could be related to the exorbitant privilege of the dollar or the key currencies, and then maybe this could provide us a step towards understanding this key currency in an international setting. And now 4 years, 2003. Actually, when I was a graduate student at Yale, I was a purely domestic macro person. And then thanks to my classmate, Sung-hyun, I was brought into this international literature. And my first paper on this first welfare reversal was edited by the Mick. So he was partly, I don't know what's the right adverb, but brought me to this. And then more seriously on this incomplete markets or financial markets, with him and Andy Levin, this incomplete market analysis was done. Actually, this was edited by Mick's longtime colleague Charles Engel. And here I learned how to understand incomplete markets in the international setting. So I had the luxury of that. And when I was working at the Fed with Andy Levin and Tak Yoon, I tried to understand this incorporation of monetary policy, only monetary policy in open economy, which was not easy. Okay, this was published in 2008 in a Korean journal after tried a few decent US journals. And then you can see how difficult it is. And also when we had a lot of research time at the Federal Reserve Board, as you can see. But that had some of that. And more seriously, on the 2010, I don't know whether you remember this or not, but right before I left the Fed to return to Korea, I was consulted by Dale Henderson a lot on this, his presentation. That he's always very serious in discussing other papers, and then I think maybe it's your former, I don't know whether you published this one and moved this, but you mentioned your earlier paper on international coordination in a liquidity trap. So this might be a precursor. And then at that time, I learned a lot from Dale about the cooperation, basically his work with, I think, Matt Canzoneri, I believe. Yeah, from all years. I think that's what, when Mick, you said your graduate school years, but maybe it's even before, your graduate school years, okay? And most recently, as I mentioned, what I learned from you last year. So for the last 3 minutes, so I'll go to 3 points, 1 minute each. First one is how to compare across models. For example, if I go to your table 1, you explain that in the paper that this with no subsidy, non-cooperative equilibrium has a higher level of consumption in the steady state, I would say. But with subsidy, the corporation has higher level of consumption, right? So on the left 2 columns, why is consumption higher with non-corporation? I think that's the stretching interaction part you have. But my question is, when you compare across models or across specifications, is it better to fix the parameters and change coordination or subsidy or others? But in other cases, in the early real cycle papers, they tried hard to match the steady state, right? Exposed steady state of the model by changing the parameter values. I don't know which one is a better analysis in this paper, but maybe we should have that in mind. That's because you are doing the welfare analysis in the paper, right? Of course, you did nonlinear, so usual like first welfare reversal for the second order doesn't apply here. But there is a 0th order, matters a lot for welfare. So maybe being more explicit about this steady state issue would be helpful. The second one was the commitment issue. And in the paper, you said that trade policy is harder to change. So you use constant tariff as a commitment or the long-term policy. But in the central bank, they are more agile, but they are more independent as well, right? The trade policy, as you observed in the last several years, from Obama to Trump to Biden, I don't know which one is easier to commit. And then if I introduce commitment for the monetary policy, then the stabilization bias came in after, as well as the inflation bias. And that might be very interesting to analyze together, because in this paper, you're focusing on the inflation bias side, the Rogoff bias side. Okay. And the last one was the international financial markets. And then as you showed, there's no financial markets, but in your presentation, I heard that you have some results available for this incomplete financial markets. Maybe if you say a word, at least whether it's the Rogoff results survive with incomplete or even complete markets, that would be helpful. And then I don't know whether you use, but we will have wealth dynamics in such a case. And then our chair, Martin Bodenstein, has a nice codes available, I think online and publicly with Luca Guerrieri. So you can easily put in this your model into this dynamic code, I believe, and to analyze. And then, but maybe you have done that already, I can tell from your presentation. Okay, thanks a lot.
Well, thank you very much, Jinill. Mick, there are two questions that came up in the Q&A chat. So I can read them out loud a little bit so everybody knows about them, or do you already want to?
I can read them. Probably I can
Perfect.
read them out. But all the participants can see the questions anyway, right? So I don't really need to repeat them.
Sounds good.
Right?
Okay. No, you don't have to.
No.
But if you give a sense of...
Only some can see.
Okay.
Oh, I see.
okay.
Not everyone can see. Okay, so maybe I should respond quickly to Jinill's comments first. So on the welfare analysis, everything is at the steady state here. In fact, the model is just solved in terms of a perfect foresight framework. And it's solved non-linearly, so we don't have to, in the kind of Woodford-Benigno analysis and the Benigno's issue about cooperation, there's a different steady state in the that you approximate around when you look at cooperative versus non-cooperative. So that leads to kind of conceptual problems. Here, we're not approximating, it's the actual full kind of non-linear solution. So I don't think we have to worry about that, but maybe I misinterpreted what you said.
Mm-hmm.
So
Partly,
on the commitment issue, what we do find is that if there's what we call kind of quasi-commitment, then there's going to be less protection, because the policymakers actually take into account the impact of the tariff on inflation. But I guess the motivation for our paper is that it looks like, trade policy, at least, under the last administration, was being set very much according to discretion. There were tariffs responding to, Mexican immigration, to Argentinian currency movements, to Brazil's exchange rate, to China and everything. So, tariffs were coming thick and fast in a discretionary way. So, so that was kind of one of the motivation. On the international financial markets, we have extended the model to allow for international financial markets. It's a bit tricky because when you go towards more market completeness, the standard kind of learner symmetry doesn't hold anymore, and tariffs have kind of different effects. So there may be for instance, with complete markets, there are no terms of trade manipulation incentives in tariff rates. So it's you have to stay away from fully complete markets. So, but with some market incompleteness, we do have quite similar results. So let me just kind of focus on the other questions. I think Pushan Dut asked a question: trade wars, according to economists, are about terms of trade. However, politicians see trade wars about employment. Trade wars. Okay, so this is a big issue, and on a previous paper we've had extensive discussions with referees about this. The issue is, is the terms of trade motivation, is that channel important for tariff analysis? There's a big literature in trade policy and trade theory about this, and we're kind of taking it as an assumption that the terms of trade at least is one motivation for tariffs. But we do have actually, in fact, a section in the paper, I didn't have time to go over it, on the trade policy in a liquidity trap. And interestingly, we find actually that protection should be lower in a global liquidity trap than under the baseline case. Takeo Hoshi asked a question. I'm puzzled by the results that show monetary policy coordination versus situation because I thought monetary policy could cooperatively decide to act in the same ways as non-cooperatively. So, I mean, we're actually, we're levering very much off the ROGOC results is that, there's actually, more than two players. There's a private sector as well. And so when you have time inconsistency, then cooperation can make things worse. So in fact, the result that cooperation is always better is not the case in this framework. And Alessandro asked, I wonder what the implicit assumptions of the persistence of the trade war and how temporary versus permanent changes in tariffs may affect the equilibrium. Well, we don't really have much of a dynamic analysis. We do look at the impact of shocks here, but really, I mean, essentially our results are kind of, like steady state results. It would be, I mean, very interesting and obviously on the agenda to look at more dynamic issues here.
Mig, your constant tariff commitment case would be helpful in answering this question, isn't it?
The constant tariff
commitment.
Oh yeah. That's true on the persistence.
Alessandro, I believe.
Yeah. Mm-hmm. So
There's another question for Ipe.
Sorry.
There was also a question by Ipe.
Oh, I didn't. Oh, sorry, I didn't. Ipe's question: can you compute the conditional welfare given asymmetric initial states? Right. Yeah. So again, in the paper, we look at some asymmetry, and we find, interestingly, there's another kind of dichotomy between the currency war and the trade war. We find. Interestingly, and I'm not sure that this result is actually known in the monetary policy literature. In the non-cooperative monetary policy game, large countries do worse in our framework because they focus more on the monopolistic distortion, and they end up with higher inflation rates just in the currency war alone. So size actually is not good in terms of welfare. But when we add on the currency war and the trade war, it turns out large countries do significantly better because they have very efficient mechanisms for manipulating their terms of trade, which is the tariff rate. And large countries will set significantly higher tariffs according to this analysis. So asymmetry does matter a lot. And, I tried to squeeze everything into 15 minutes. So I didn't do that. So.
Well, thank you very much, Mick. So I don't see any additional questions in the chat. I certainly have still some questions and would have lots of comments, but maybe I'll just take this offline and I'll take some time tomorrow to compose you an email to this very interesting paper. So as you know, I've been working on related stuff, but I think I'll take this. I could probably hijack the remaining 45 minutes of this session with you. Okay. But now without further ado, thank you very much to Jinill and Mick for these very inspiring discussions and presentations.